Today we bring you a crucial update from the heart of Wall Street. We're live from the NASDAQ in New York City, where the earnings season is in full swing. This week, eyes are fixated on the financial giants Goldman Sachs and Bank of America as their results are due to be unveiled. In the wake of robust performances from their Wall Street counterparts last week, the current spotlight falls on the executives' cautious warnings about potential rough patches ahead. During the latest earnings call, JP Morgan CEO Jamie Dimon issued a stark statement, calling this period the most dangerous time the world has seen in decades, emphasizing the bank's preparation for a range of outcomes. Adding to this sentiment, Citigroup CEO Jane Fraser highlighted the impact of recent macro headwinds on investor sentiment. The contrast between these cautious warnings and the solid financial results triggers the need for a deeper understanding of the current market dynamics. Ben Eisen, a reporter from the Wall Street Journal, says the following: "The results from the big banks seem quite solid, but there's an air of caution permeating the industry. What's your assessment of the earnings season so far, considering the pessimistic outlook some executives have expressed?" Well, what you're seeing is that many bank executives are signaling that we're at a critical juncture. Consumer spending has defied expectations, holding up impressively despite the interest rate increases. However, the downsides of these higher rates are beginning to surface. Loan losses are on the rise, loan demands are cooling, and the friction caused by elevated interest rates is becoming more noticeable. Indeed, consumer behavior plays a pivotal role. Jamie Dimon, the CEO of JP Morgan, has highlighted the dwindling excess cash buffers among consumers and their spending habits. How much longer do you think consumers can endure this pressure? And what ripple effects might this have on the broader economy? Consumer resilience in the face of economic challenges remains a significant factor to monitor. As the cushion of pandemic savings gradually depletes, the endurance of consumers will heavily depend on various factors, including job security, wage growth, and overall economic stability. The spending patterns of consumers act as a crucial driver for various industries and sectors, thus influencing the broader economic landscape. Any significant shifts in consumer behavior could potentially ripple through the market, impacting everything from retail and real estate to manufacturing and services. Furthermore, with the emergence of inflationary pressures, the real purchasing power of consumers could erode, potentially leading to altered consumption patterns and a slower pace of economic recovery. The delicate balance between stimulating economic growth and ensuring financial stability hinges on understanding how long consumers can withstand these mounting pressures and how policymakers can intervene effectively to mitigate any adverse consequences. How have your spending habits evolved over the past year, and what factors have influenced your financial decisions? Do you foresee any changes in your consumption patterns as a result of the current economic climate? Share your views in the comment box below. Shifting the focus to workforce dynamics, many analysts are closely monitoring the headcount reductions across industries, especially within the banking sector. PNC recently announced a 4% reduction in their workforce. Do you foresee this trend continuing among regional players in the upcoming quarters? And what implications might this have for the labor market and overall economic recovery? Job cuts, particularly in the banking sector, reflect the challenging environment faced by financial institutions. With rising operational costs and the need to adapt to shifting market dynamics, many banks are considering workforce restructuring as a means to streamline operations and improve cost efficiencies. However, this approach also raises concerns about its impact on the labor market and broader economic recovery. The implications of widespread job cuts extend beyond the immediate workforce. They can potentially lead to reduced consumer spending, impacting various sectors reliant on consumer demand. Furthermore, a significant reduction in employment opportunities may dampen overall economic sentiment, leading to potential repercussions on investment and growth prospects. It's imperative to closely monitor how these shifts in workforce dynamics unfold and to assess their broader implications for the labor market and economic stability. Looking ahead, considering the turmoil and the challenges faced by regional banks, do you anticipate a surge in consolidation as a means to mitigate the impact of these hardships? What regulatory hurdles and market dynamics might influence the trajectory of this potential consolidation, and how could it reshape the banking industry? Consolidation remains a key consideration for many regional banks grappling with mounting pressures. As smaller institutions face intensified challenges in maintaining profitability, seeking opportunities for consolidation might emerge as a viable solution. However, the path to consolidation is not without obstacles. Regulatory constraints and antitrust considerations could pose significant hurdles, necessitating a delicate balance between fostering healthy competition and ensuring financial stability. Moreover, market dynamics and the evolving competitive landscape play a crucial role in shaping the trajectory of potential consolidation. While consolidation might offer opportunities for synergies and cost efficiencies, it could also impact market diversity and accessibility to financial services. Assessing the long-term implications of consolidation on both the banking industry and consumers is critical to fostering a resilient and inclusive financial ecosystem. In the realm of banking, technological advancements are reshaping the landscape. How are banks navigating this era of digital transformation, and what impact is it having on their operations and customer interactions? Technology is indeed revolutionizing the banking sector. Banks are increasingly investing in digital infrastructure to enhance customer experiences and streamline operations. However, this shift also presents challenges, especially for traditional institutions trying to keep up with agile fintech competitors. It's a delicate balance between embracing innovation and ensuring robust cybersecurity measures are in place. Turning our attention to the global stage, how are the banks evaluating the impact of international market volatility on their strategies and risk management practices? Are they adjusting their approaches to safeguard against potential shocks, and what geopolitical factors are contributing to this heightened volatility? The evaluation of international market volatility is integral to the risk management strategies of banks operating globally. With interconnected financial systems, banks must navigate a complex web of geopolitical and economic factors that can swiftly translate into market turbulence. Heightened trade tensions, geopolitical conflicts, and currency fluctuations amplify the challenges faced by these institutions. In response, banks are actively recalibrating their risk management practices and diversifying their portfolios to mitigate potential shocks. This entails a comprehensive assessment of their exposure to different international markets. How are banks leveraging these services to diversify their revenue streams and meet the evolving demands of their clientele in an ever-changing economic landscape? Investment and wealth management services have become an integral part of banks' revenue diversification strategies. Recognizing the growing demand for tailored financial solutions, banks are expanding their investment offerings and wealth management platforms to accommodate various client preferences and risk appetites. Through personalized advisory services and sophisticated investment products, they aim to enhance the overall client experience and build lasting relationships based on trust and expertise. With the integration of advanced technologies, including algorithmic trading and robo-advisors, banks can provide efficient and cost-effective wealth management solutions, making investment opportunities more accessible to a broader clientele. Additionally, the focus on sustainable and socially responsible investment options is gaining traction, reflecting the evolving values and priorities of investors in today's socio-economic landscape. By fostering innovation and maintaining a client-centric approach, banks can adapt to the changing financial landscape and position themselves as trusted partners in their clients' journey toward financial prosperity and security. That's all the time we have for today. As we await the forthcoming financial disclosures, it's evident that the cautionary sentiment expressed by industry leaders demands careful attention. Stay tuned for more updates and analysis on the financial landscape.